Good afternoon, folks. It is the 17th. This is your ticker guy, Carl. Let's talk about the credit markets first. Well, here's the IRX. What is the IRX? It's a 13-week T-bill yield. And as you can see, it has gone way up over the last 2 days. That's a good sign. It would normally be a great sign except for this graph, which is the short-term bill issuance by the Treasury. As you can see, it has gone ape nuts. So, what happens when you put more supply out? Of course, price goes down, right? Yield goes up. That's the way it works with bonds. So you can't take too much and read too much into what you're seeing there in the IRX, unfortunately. However, we do have some other indications that are very positive. LIBOR is moving the correct direction. Not big, but it is. It is coming in, and that is a good sign. I expected it to get smashed if this plan of Paulson's was working. That didn't happen, but at least it is moving the correct direction. However, today we had the 2-year swap spread came in by about 12%. That's a big move, guys. That kind of move normally doesn't happen in the bond markets. So that really does tell us that credit is starting to loosen up. I'm not yet hearing anything good, though, when it comes to commercial, what's called self-liquidating trade credit, things like lines of credit, stuff like that. Letter of credits that move goods across national and international boundaries. I'm not seeing that yet. Now, hopefully that will unfreeze. What's not going to unfreeze is on the consumer side. The latest is that GMAC has now said they're not going to make any auto loans to anyone under 700 FICO, and they're also not going to allow any negative amortization. Basically meaning that if you have a car that you owe $7,000 on, it's worth $5,000, you can't roll the $2,000 into the new loan anymore because they won't finance more than dealer invoice. So what this means is that you're going to have a down payment along with your car purchase. Now, for most consumers over the last 8-9 years, that has not been necessary. You've walked in, you've signed, you get in the car, you turn the key, and you drive out. Those days are over. They're never coming back, guys. Same thing with houses. And listen, mortgage rates are going the wrong way. And you say, how in the hell is that possible? They lowered the Fed funds target again. It's the bond market, guys. You can't put $700 billion worth of bond issuance and guarantee everything else in the world other than mortgages, commercial paper, Jesus. What isn't guaranteed by the federal government now without affecting spreads for Fannie and Freddie in particular? And that's what's happened, is that those spreads have started to blow out. As of yesterday, stood at a record. This is very bad news if you're trying to buy a house. All right, so the bottom line is mortgage rates are going up, even though nothing else is. Hey. And we still have the volatility in the stock market. We are off the hoard rice, beans, and gallons of water in your pantry watch for the time being, assuming the credit market continues to go in the right direction. But what we're not off is the general credit malaise, the impact that this is going to have on manufacturers, the impact this is going to have on employers. You're going to see unemployment continue to ramp. You're going to see real wages in terms of your purchasing power go down. The easy credit spigot has been shut off. I predicted this a year ago it was going to happen. I started to see the deterioration in consumer credit, specifically in credit cards, in some of the statistics in the quarterly reports and in the Federal Reserve's reporting. Nobody paid any attention to it. Well, now it's real and it's happening. It's here, and you have to live with it. The other thing that you have to be aware of, guys, is that the distortions that have been put into the marketplace by what Henry Paulson and Ben Bernanke have done is they're astronomical. And exactly how they're going to sort out over time, nobody can determine at this point. What I can tell you is that you're not likely to like how this ends up working. As one example, there are some math analyses that have been done on this preferred stock issuance he's putting in that show that we're actually essentially giving away huge parts of that money. We're giving it to the banks. It's not a loan. It's not secured. It's essentially a gift. And this is just using net present value calculations for how you would price this stuff if you were a private issuer and you were going to go in there and you were going to figure out what kind of interest rate you'd have to charge, what kind of coupon you get, what the warrants are worth, and things like this. These are all mathematically determinable, guys. And the bottom line is the bank's got a sweetheart deal and you got screwed out of about $125 billion. Welcome to reality. This is how it works in the United States of America. Yeah. So anyway, there you have it. The basic principle in corporate governance, guys, is if you screw it up, you don't get to fix it. You get fired, somebody else comes in. Well, Henry Paulson is one of the guys that screwed it up. He was one of the people that lobbied very heavily to have the leverage limits taken off of the investment banks. Now we're going to have him design the system that supposedly takes care of this. I doubt it. The agitation from Europe and the rest of the world is getting very loud. It's getting very cohesive. They're talking about a rework of Bretton Woods. I'll believe it when I see it. All right, there's going to be a lot of political infighting over this, guys. It's not over by any stretch of the imagination. What is over, however, is the presidential race. Okay, sorry. Go take a look at the electoral vote count. Absent Barack Obama getting caught with a goat, he's going to be president of the United States. That's the way it is. Get used to it. If you like that, that's great. If you hate it, that's too bad. Sorry, it doesn't matter how you vote. At this point in time, guys, I don't think there's anything that can be done to change the outcome. The problem for this is that that's going to mean even more issuance. We're talking about $1.5 to $2 trillion worth of deficit this fiscal year, probably 2 to maybe as high as 3 next fiscal year, 2009 fiscal. That's a disaster. It's going to drive up borrowing costs. It's going to force curtailment of programs. Eventually, the bond market is going to react to this, and it's going to get very unfunny. You've got people running around saying that the government has to lever up because nobody else is willing to. What this really means is we're all losing our shirts. Therefore, the government has to eat it. It doesn't work that way, guys. Anybody that's got half a brain knows that the government doesn't actually possess anything. They tax it from you. So, where's it come from? Right. All right. Not the easy. There's nothing difficult here. But when you hear people like Al-Baghdadi and PIMCO's guy, Bill Gross out there talking about how the government needs to lever up because private industry can't. The fact of the matter is the government can't lever up either, because guess who that is? That's the consumer, because you're the one that pays the taxes. Reality, all right? The clue stick will come and hit these guys upside the head, and it won't take very long. In terms of the market, S&P 500, 12 to 24 month target, guys, 500. Why? Because we had a double top. We broke critical support. The next place that you expect to find that critical support is at the bottom of the entire move. All right. Unfortunately, that means that 20 years plus worth of gains are going to be wiped out if you stay in this market. Could I be wrong about this? Sure. All right. This is just my view of it, and I'm not alone. I've seen this from other people as well, but that is now my 12 to 24 month target on this, and a huge part of that move down from where we are now, right around the 940 area. I guess we went out with that 930-ish today, down to that 500, which, by the way, is a 50% collapse. I think you could see half of that happen in the space of a day or two. All right, so there's a crash coming. I know what you saw so far is not a crash. It's a really bad deterioration, but it's not a crash. What you're likely to see in the future is a crash. We've got a bond market dislocation potentially coming from all this issuance, and we've got other things that in terms of prognostication for the economy, are just horrible. I don't see anything good on the horizon here. I see unemployment going up. I see real wages in terms of actual income coming down. It's going to squeeze people. There's going to be a lot of personal bankruptcies. There's going to be a lot of personal hardship. I wish there was some way to make it not that, but that's what we're dealt with at this point. The credit monster is going to eat all of the things it wants and all of the things it needs to satisfy itself. If you're wondering where the daily updates are, guys, I don't do them on video unless there's something really weird going on. If you want to get daily updates, however, you can go over to market-ticker.denninger.net. That's my daily blog. It's out there. There's also an online discussion forum called tickerforum.org. They are independent of one another, but I run them both. Ticker Forum is free to use. There is a donation system if you want additional features, but the basic functions of the system, including the ability to actually have discussions with other people. We don't just do the read-only thing. You have to pay to get in. No. You can log in, get yourself a login ID, and you can actually browse most of the system without signing on at all. And the blog itself at market-ticker.denninger.net has at least daily commentary, sometimes 2 or 3 times, right, depending on what's going on a particular day. Anyway, that's all I got right now. Again, basic synopsis. I don't see anything great in the stock market here. I don't see anything great in the credit markets. But the panic level, oh my God, the world's going to come to an end and the grocery stores will be empty, that has eased off some. We need to see more improvement. By next week, we should know whether or not the spreads continue to go in the correct direction and the tension continues to come out. Let's hope it does. I don't like the idea of having to stock up my pantry, all right? And I'm sure you don't either. Have a good evening, and I'll see you soon.